This isn't a glitch. This is what happens when the central bank becomes the lender, the buyer, and the bagman all at once. And the unwind has already started, quiet and mechanical, while headlines chase inflation prints and rate hikes. What's being unwound isn't just bonds. It's the logic that held the system together since 2008. This video covers 3 parts you won't hear in the press briefings. First, how the Fed turned itself into a $8.7 trillion leveraged hedge fund without admitting it's leveraged. Second, the hidden remittance trap that changes everything about future monetary policy, and why the Treasury now has to choose between the Fed's balance sheet and its own spending. And third, the mechanism that determines whether your mortgage, your paycheck, and your savings survive the next 18 months intact. There's a timeline window, there's a structural breaking point, and there's a group of institutions already positioned on the other side of this trade. We'll open all 3 by the end. Let's start with what you already know, or think you know. The Fed's balance sheet exploded during COVID. Everyone saw that. It went from $4 trillion to nearly $9 trillion in less than 2 years. The explanation was simple: liquidity crisis, pandemic emergency, keep markets functioning, buy bonds, suppress rates, keep credit flowing. That's what central banks do in a crisis. Textbook stuff. And when inflation showed up in 2022, the Fed pivoted. Rates went from 0 to over 5% in 16 months, the fastest hiking cycle in 40 years. The balance sheet started shrinking through quantitative tightening, QT, letting bonds roll off without reinvestment. The mainstream story says this is just normalization, tightening after loosening, draining the punch bowl, standard procedure. But here's what that story doesn't mention. Every single bond the Fed bought between 2020 and 2022 was purchased at historically low yields, many below 1%, some near 0. When rates rise, bond prices fall. Not a little, a lot. If you're holding a 10-year Treasury yielding 0.6% and the market rate jumps to 4.5%, that bond isn't worth par anymore. It's worth maybe 70 cents on the dollar. The Fed is holding 8.7 trillion of these. That's over $1 trillion in paper losses. Unrealized, yes, but real in every way that matters when you're trying to shrink a balance sheet or defend a currency or signal credibility to the rest of the world. And here's the part they bury in footnotes. The Fed doesn't mark to market. It holds these assets at amortized cost. So the loss doesn't show up as a loss. It shows up as negative income because the interest earned on those low-yield bonds no longer covers the interest the Fed has to pay to banks on reserve balances, which are now pegged above 5%. The Fed is paying more than it earns, and that gap, that's the remittance problem. The Fed used to send tens of billions a year to the Treasury. That's over. Now it's accruing a deferred asset, a polite term for IOU to itself. The Treasury gets nothing, and the longer rates stay high, the bigger that IOU grows. Now we look under the hood. Mechanism 1, reserve interest as the Fed's new primary expense. The Federal Reserve pays interest on reserve balances, IORB, to every bank that parks money at the Fed. Before 2008, reserves paid nothing. After 2008, they started paying a little. After 2022, they're paying over 5%. That's the floor of the entire interest rate structure now. It's not optional, it's the tool. But here's the feedback. The more reserves in the system, the more the Fed has to pay out every single day. And despite QT, reserves are still around $3.3 trillion. That's $165 billion a year in interest expense at current rates. The bonds the Fed owns, they're yielding an average closer to 2.3%. Do the math. The Fed is underwater on its carry trade. This wasn't supposed to happen because rates weren't supposed to stay high this long. The assumption in 2020 was that emergency purchases would be unwound slowly in a low-rate environment with plenty of time to let bonds mature at par. Instead, inflation forced the Fed's hand, rates spiked, duration risk materialized. The balance sheet became a liability instead of a tool. The incentive now is clear. The Fed needs rates to fall, not to help the economy, but to stop bleeding. But it can't say that. So every speech mentions data dependency and inflation targets and flexible policy. What they don't say is that every month above 5% costs the Fed roughly $13 billion in negative carry. Who benefits? Banks. They're earning 5% risk-free on reserves while lending cautiously and tightening credit. The Fed is subsidizing bank profitability at its own expense. Retail sees higher savings rates and thinks it's a gift. It's not. It's the cost of keeping reserves inside the system so they don't flood into the economy and reignite inflation. The trapdoor here is that the Fed can't lower IORB without losing control of short-term rates. It's locked in. And retail finds out 18 months later when their credit card APR hasn't dropped, even though the Fed started cutting. Mechanism 2, Quantitative tightening as a silent liquidity drain. QT is supposed to be boring. Let bonds mature, don't replace them. Balance sheet shrinks slowly, reserves decline gently, no drama. But that model assumes banks and markets don't need those reserves. They do. Here's the plumbing issue. Reserves are the lubricant of the overnight funding market. Repo, Fed funds, short-term collateral markets, all of it runs on reserve availability. When reserves drop below a certain threshold, friction appears. Rates spike in weird places. Liquidity fragments. We saw this in September 2019 when overnight repo rates suddenly jumped to 10% because reserves fell just a bit too far. The Fed had to intervene immediately. That threshold is called the LC lore, lowest comfortable level of reserves. Nobody knows exactly where it is. The Fed guesses it's somewhere between 2.3 trillion and 3 trillion. We're at 3.3 trillion now. Sounds safe. But the pace of QT has been $95 billion a month. That means we're about 4 to 8 months from the danger zone, depending on Treasury issuance and tax flows. Here's the constraint. The Treasury is also issuing debt at record pace to finance deficits. Every new T-bill issued pulls reserves out of the banking system because someone has to buy that bill with reserves. So QT plus heavy issuance equals a faster drain than the models predicted. The market reaction chain is already visible. Basis trades are widening. Liquidity in off-the-run treasuries is deteriorating. Hedge funds that rely on leverage are quietly dialing back. These aren't headline events. They're micro fractures. The time delay is the key. By the time the Fed realizes reserves are too low, the stress is already propagating. Fixing it takes weeks. Announcing a new facility, injecting liquidity, calming markets, none of that happens instantly. And during that window, volatility spikes, and someone has to absorb the loss. Who benefits? Dealers and prime brokers who control repo and collateral chains. They see the tightness first, adjust their rates, and extract rent from everyone downstream. Hedge funds with cash on hand buy dislocations. Retail investors watch their bond funds swing wildly and don't know why. Retail is late because they don't monitor reserve levels or Fed funds effective rate or tri-party repo fails. By the time it shows up in a brokerage account, the dislocation is old news to the professionals who already repositioned. Mechanism 3, the Treasury-Fed coordination mirage. The official line is that the Fed and Treasury are independent, separate mandates, separate authorities, no coordination on fiscal and monetary policy. That's the theory. The practice is different. When the Fed stops sending remittances to the Treasury loses a revenue stream it was counting on. That's real money. Tens of billions a year that used to show up automatically. Now it's zero indefinitely. The Treasury has to either cut spending, raise taxes, or issue more debt. All three are politically difficult. So Treasury issues more debt. But who buys that debt when the Fed is in QT? Not the Fed. It's letting bonds roll off, not buying new ones. So the private market has to absorb it. That means higher yields unless demand stays strong. And demand has been wobbly. Foreign central banks are selling treasuries to defend their currencies. China's holdings are down. Japan is intervening at home. The buyer base is shrinking while issuance is accelerating. The Fed sees this. It knows that if Treasury yields spike, mortgage rates spike, corporate borrowing costs spike, and financial conditions tighten faster than the Fed intended. That undermines the whole exercise. So even though the Fed says it's independent, it's watching Treasury issuance like a hawk because Treasury stress becomes Fed stress within weeks. The liquidity involved is this. Every incremental dollar of Treasury issuance at higher yields pulls capital out of credit markets, equity markets, and risk assets. The Fed can't directly control that flow, but it can adjust the pace of QT to offset some of it. The problem is that offsetting it too much means abandoning the inflation fight. The Fed is caught between two incompatible goals. The market reaction chain starts in the belly of the Treasury curve, the 2-year to 7-year range. That's where issuance is heaviest and where liquidity matters most for corporate finance. If those yields rise faster than the long end, the curve inverts more, recession signals flash, and equity markets reprice risk. We've already seen this twice in the past 18 months. The time delay, nobody notices. Treasury typically funds itself with a lag of about 60 to 90 days from the decision to issue to the actual settlement. By the time the debt hits the market, macro conditions have often shifted. The Fed is tightening based on data from 2 months ago. Treasury is issuing based on deficit projections from last quarter. Nothing sinks. The compounding mismatches show up as volatility that everyone blames on uncertainty or geopolitics, but it's actually just temporal lag in policy transmission. Who quietly benefits? Primary dealers who underwrite Treasury auctions. They see the issuance calendar in advance, they know the Fed's QT pace, and they position accordingly. If demand looks weak, they bid lower, yields rise, and they flip the bonds to real money accounts at a spread. The Treasury pays the cost, taxpayers pay the interest. Retail is late because auction results come out after the fact, and by then the pricing is done. If you're buying a Treasury ETF or a bond fund, you're getting yesterday's auction at today's price with tomorrow's risk built in. Mechanism 4. The mortgage market's hidden subsidy, unwind. The Fed doesn't just own treasuries. It owns $2.5 trillion in mortgage-backed securities, MBS, bought during the pandemic to keep housing finance from seizing up. Those MBS were purchased at rock-bottom mortgage rates, most below 3%. Now, mortgage rates are above 7%. The value of that MBS portfolio has cratered. Here's the incentive structure. The Fed can't sell MBS into the market without tanking prices further and signaling panic, so it's letting them run off passively as homeowners pay down or refinance. But here's the catch. When mortgage rates are 7%, almost nobody refinances. Prepayment speeds collapse. Those MBS mature much slower than expected. The Fed is stuck holding them longer, bleeding carry costs the whole time because it's paying 5% on reserves while earning maybe 2.8% on MBS. The liquidity issue is that MBS are less liquid than treasuries. Spreads are wider, bid-ask is higher, and during stress, MBS liquidity disappears entirely. The Fed holding $2.5 trillion of them makes the market look stable, but it's artificial. The moment the Fed steps back, the private market has to absorb that float, and there's no appetite at current prices. The market reaction chain starts with mortgage originators. They can't sell loans into the secondary market at attractive prices because MBS yields are too high relative to Treasury yields. So they tighten lending standards, raise fees, and slow originations. Housing turnover drops. Existing homeowners are locked in by their 3% mortgages. The housing market freezes, not from lack of demand, but from rate and liquidity structure. The time delay, it takes about 9 to 12 months for changes in MBS market liquidity to fully show up in housing data. By the time you see existing home sales collapse or new listings crater, the credit tightening already happened months ago. Builders react late. Buyers wait. Prices either stay sticky or fall sharply depending on local employment. It's fragmented, slow-motion deterioration. Who quietly benefits? Large institutional landlords and private equity real estate funds. They have cash, they're not rate sensitive the way retail buyers are, and they can buy homes without mortgages or negotiate seller financing. They're accumulating quietly while the retail market is paralyzed. Why retail is late? Retail buyers depend on mortgages. They see the 7% rate, they see the monthly payment math, and they freeze. By the time rates drop, if they drop, institutional buyers have already repositioned and prices adjust upward faster than rates fall. The affordability window never actually opens for the average buyer. It was a mirage created by rate structure and liquidity timing. Mechanism 5, foreign central bank reserve recycling breakdown. For decades, foreign central banks bought U.S. treasuries with their dollar reserves. It was automatic. Export to the U.S., earn dollars, park them in treasuries. This kept treasury yields low and funded U.S. deficits painlessly. The Fed didn't have to do much. Foreigners did it. That's reversing. Not because they want to, but because they have to. Currency stress is forcing reserve drawdowns. China is intervening to slow the yuan slide. Japan is intervening to stop yen collapse. Emerging markets are burning through dollars to defend pegs and pay commodity import bills. All of that means selling treasuries. The institutional incentive here is survival. A central bank that lets its currency collapse loses domestic credibility, faces inflation spirals, and risks political instability. So they sell treasuries even if it means taking a loss on the bonds they bought at lower yields. It's a forced liquidation, not a strategic choice. The liquidity constraint is that there aren't enough marginal buyers to replace them at current prices. The Fed is in QT, so it's not buying. Japanese households already own massive amounts. European banks are dealing with their own rate and sovereign debt issues. The incremental buyer has to be a U.S. institution or a leverage fund. Both demand higher yields to take the duration risk. The market reaction chain is foreign selling pushes treasury yields higher, which strengthens the dollar, which increases foreign currency stress, which forces more foreign selling. It's a feedback loop. The Fed can't stop it directly without restarting QE, which would contradict the entire inflation-fighting narrative. The time delay nobody notices. Foreign reserve data is reported quarterly with a lag of about 6 weeks. By the time the Treasury International Capital data shows selling, it's old news. Markets react in real time to price action, not the data release. So yields rise, the dollar spikes, and everyone guesses why. The pros already knew from flow data and repo market signals. Retail finds out from the news after the move is done. Who quietly benefits? currency hedge funds and macro traders who track reserve levels, intervention patterns, and cross-border capital flows. They position short foreign currencies and long the dollar before the broad market realizes the feedback loop is accelerating. They also buy volatility in FX and rates because this kind of liquidation creates dislocations that are predictable in direction but volatile in magnitude. Why retail is late. Retail investors don't monitor TIC data or central bank swap lines or covered interest parity breaks. By the time the dollar strength shows up in their international equity funds as a headwind, the move is mature and often about to reverse on short-term technicals. They react to outcomes, not flows. Mechanism 6, the political optionality trap. Here's the mechanism almost nobody connects. The Fed's losses and the remittance freeze give Congress a political tool disguised as a crisis. If the Fed is losing money, there's a narrative that it was reckless, over-leveraged, captured by Wall Street, or mismanaged. That narrative can be weaponized. The institutional incentive is power. Congress doesn't control monetary policy directly, but it controls the Fed's legal charter, its oversight, and its governance structure. If the Fed looks weak or incompetent, Congress can threaten legislative action, audits, board restructuring, limits on emergency lending, restrictions on the balance sheet. Even the threat changes Fed behavior. The liquidity involved isn't money, it's political capital. The Fed depends on independence to function. If that independence is questioned loudly enough, the Fed has to become more risk-averse, more cautious, more communicative with Congress. That slows decisions, complicates policy, and creates lag when speed matters. The market reaction chain is indirect. Congress doesn't move markets by passing laws. It moves them by signaling uncertainty about the rules. If there's serious talk of restricting Fed tools or requiring congressional approval for emergency facilities, then the next crisis becomes more expensive to solve because markets know the Fed's hands might be tied. Risk premia rise across the board. Credit spreads widen. Liquidity becomes more expensive preemptively. The time delay is months to years. A hearing happens. A bill gets introduced. Nothing passes. But the signal is out there. The Fed adjusts quietly. Markets adjust subtly. By the time it's clear that nothing changed legislatively, behavior already changed operationally. The Fed is slower to act, more conservative, more worried about political optics. That caution costs real money during the next liquidity shock. Who quietly benefits? Anyone positioned for policy paralysis, short volatility sellers before a crisis, long volatility buyers when uncertainty spikes, and credit investors who can extract higher yields from borrowers who now face a less reliable lender of last resort. Also benefits foreign central banks and institutions who gain relative credibility if the Fed looks constrained. Why retail is late? Retail doesn't watch CS-PAN or read Federal Reserve Act amendment proposals. They see headlines months later after the narrative is set, and by then markets have already discounted the risk. Retail buys after the dip, not before it, because they don't track the political optionality that creates the dip in the first place. Mechanism 7, the inflation-deflation prisoner's dilemma. The Fed is stuck in a game theory trap. If it holds rates high to crush inflation, it deepens its own losses, delays economic recovery, and risks a credit event or a recession that forces emergency rate cuts anyway. If it cuts rates preemptively to stop the bleeding and restore remittances, it risks reigniting inflation and losing all credibility, which means the next inflation cycle is worse and requires even higher rates. The institutional incentive is to avoid the second option at almost any cost because credibility is the only real asset a central bank has. Lose that, and you become the Bank of England in 2022 or the Banco Central do Brazil in the 1980s. The Fed will accept a recession before it accepts an inflation spiral. The liquidity constraint is that credit creation depends on expectations. If businesses and banks believe rates will stay high for years, they don't borrow and they don't lend. If they believe rates will fall soon, they extend duration and